Okay, we're gearing up here on a new episode of 51% Attack. It's been a long time since I've done one of these, and I think today is worth recording one because I'm about to sound like every other clown on YouTube. Nobody else on YouTube is talking about this indicator. Well, in this case, it's true. At least I follow a lot of people on YouTube, and I actually haven't seen anybody mention this pattern yet. So I don't know. Maybe I'm the first, or at least I'm the first of the people in my circles. Um, and so yeah, let's get underway. We're going to be talking about the yield curve almost exclusively. I don't want this video to run too long, even though I always say that. A few caveats before I dive into the chart. First is that even if this indicator we're about to talk about fires off, this is not a time to panic. Like there's nothing that's going to happen today, tomorrow, this week, this month, this quarter, or even likely up to a year. This thing is going to take months to resolve and up to a year to resolve. So first, before we start the video, take a nice big breath, get a drink, alcoholic or non-alcoholic, whatever you want, and we're just gonna talk about it. Second is that my drink of choice, because I kind of rushed to jump on this stream, is a soda. So if my voice sounds weird, soda is not my drink of choice when I'm recording using my voice, because that's just the opposite of optimal. So if I'm clearing my throat a lot, that's why. And let's see, what other caveats do I have? We had don't panic, we had soda. I switched back to another version of OBS since my last 51% attack, so hopefully I'm using the software correctly and this is coming through. YouTube says it is. I can see my mouse moving around. And the last thing is, so I'm recording this video somewhat, I don't know if optimistically is the term. Technically speaking, the yield curve candles go into the post market of the day, and so there are 40 minutes left for this candle to actually close. And as you can maybe already see on the screen, it is indeterminate, but certainly at an interesting point. Okay, without further ado, let's talk about it. So here we are. We are on the most popular yield curve, which is the U.S. 10-year yield over the U.S. 2-year yield. If you've watched in the past, you know why this is so important. If you haven't, I'll try to do a very quick primer. This is the United States Federal Reserve's favorite chart for yield curve inversions and seeing how bond sell-offs, bond purchases, and how yields, are faring. It's a major sign of economic health for, again, the Fed, but also, people who follow economics. Normally, we don't look at it on a daily scale. I'll explain why the daily was important today. Potentially important. Potentially. Still have a question mark for another 39 and a half minutes. But again, just continuing with the quick primer of the yield curve, this is basically a sign of economic health because the 10-year yield is, of course, the opposite of how many people own 10-year bonds. Similarly, the 2-year yield is an inverse of how many people own 2-year bonds. Thus, it's a sign of how people who buy such things are viewing the next 2 years versus the next 10 years in the economy. What is a yield curve inversion? That is when the 10-year yield over the 2-year yield drops below the 0% mark, which is to say that more people are betting that the next 2 years are going to be worse than will be in 10 years. And traditionally, when the yield curve inverts, that eventually leads to a recession, the timing of which can be, well, we'll discuss that in a second. But again, TLDR, this is the 10-year over 2-year yield curve chart, and it's a sign of economic health that is agreed upon by everyone from the United States Federal Reserve to the trillion-dollar market makers of the world. And yeah, again, usually we look at it on a much longer chart, such as the weekly, with all these fun lines. Real quick, let's go back to that daily, which we're not going to look too much on, but I just want to show you why today was very, very interesting and continues to be interesting. Oh man, they are fighting for it. So you can see I've put this marker I had it sort of estimated. I was posting in Discord, and I was using an estimate before, but I really dialed it in today because the actual number to watch is there now, which is negative 0.479. Sorry, I said that wrong. And what does this represent? Really quick, let's just respect how the market is dealing with this line today. It is very clearly an important number. They are, first of all, they're currently stopped at it with 37 minutes left in the day. They're stopped right on it, negative 479, negative 479, and they've been bouncing up and down around it. I can't do an hourly because I don't pay for TradingView. If you were to see an hourly, it's been bouncing up and down, up and across and down, back down over 479 for the past few hours. It's basically an incredibly exciting event on the least exciting chart you could possibly imagine. Okay, enough with the daily. I've explained to you that it's clearly important. Let's look at why it's important. First of all, where did I get this number from? Where did I get negative 0.479? Let's go back a few months now at this point, and I'm pulling it from here, the end of the week on the week that started on Monday, May 1st. And this was the last time, this is the previous lower high. The previous lower high before a new lower low was put in. Again, these charts are really tough to look at. Let's see if I can do the log scale. It's not giving me a log scale right now. Sorry about that. Okay, zooming out kind of helps. Otherwise, you'll just kind of have to follow along and somewhat take my word for it, but it's all backed up by the numbers. So back in the week of May 1st, closed the week at a fresh lower weekly high of negative 0.479, which is the number we're deriving for today. After May 1st, the yield curve went down and set a new lower low. Doesn't matter where it is. It was here in late June, closed at negative 1.057. That part doesn't really matter so much. Just that it was a lower low. But what could potentially happen, and they're still fighting, is if this week closes in 35 minutes, we're looking at the first higher high after the lowest low on the yield curve weekly chart. Sorry, my dog is barking in the background. This is a weird time of day to record. I'll just push through. So again, to reiterate, if this closes above negative 0.479 and they're fighting, it will be the first weekly higher high on the yield curve since potentially the lowest low. Typically, a new higher high leads to the low being in that even if the yield curve comes back down in a few weeks, theoretically, statistically, it will put in a higher low above this June number. So what happens when you get a weekly higher high on the yield curve chart? Let's take a history lesson. It's pretty interesting. So we're not going to talk about COVID because COVID was an exception. It was a black swan. It throws off a lot of statistics. It doesn't invalidate the statistics. It's just it happens so fast that it's more of an outlier than anything. But it doesn't invalidate what we're about to talk about. Let me say, if you actually dive into the numbers, it still works out. But there are much, much bigger fish to fry. So let's go back to yeah, you can already see. Anybody who's watched my videos knows where this is going. So first up, let's talk about the obvious. What happened prior to the great financial crisis of 2008? What happened when we saw our first weekly higher high on the yield curve prior to its an inversion? Let's take a look. So the first time we put in my vertical line is wrong. It's over here in late February. Let me move that. Although I guess maybe I put that on the higher low. I might have put that on the higher low. Either way, you'll all forgive me. This doesn't matter on a day-to-day or even a week-to-week basis. It's more about the trend. But for right now, I'll adjust this to make sure we do have the first weekly higher high. So we're back in late 2006, early 2007. We had first of all, we're on the weekly chart of the yield curve. And to kind of go and fast forward, we had a fresh lower low in January of 2007 on the weekly. And then just a few weeks later, in late February, we got a fresh higher high on the weekly. Keep this in mind. Late February of 2007 is the first time that the yield curve put in a weekly higher high. And now let's head over to the SPY. SPY, and remember, keeping this date in mind because I haven't put it. I did a little prep for this video, obviously, because I knew this potentially could be coming, but the lines are not all there. So we're going to remember February 26, 2007, and head over to the SPY. Okay, everybody's familiar with this chart by now. If you've watched my videos, we've looked at the SPY and what happened during the crisis. But right now, we're trying to get, 51% of tech is about, if you're just barely right 51% of the time versus 49, it can mean the world. And so that's what we're all about. We're going to try to get even the tiniest leg up. Here we are. Same week. February 26th, 2007. We had a nice little dip. So broad markets dipped the first time we put in that weekly higher high, which not terribly far off from what we've seen around here. This is back in the present day. Interesting. I haven't measured anything. I'm just remarking on it live. I'm doing this. Fuck it, we're doing this live. Anyway, but back to the important thing. Let's go back to February 26, 2007. What happened? We had a little bit of a dip, and then, we headed into what would become the double top of the market, which brings me to my first point. If this indicator does indeed fire off, and I'm keeping an eye on it on the side of my screen, it's currently at 477, still above for now. Oh God, my screen keeps resetting. I'm so sorry. I'm out of practice with this. I won't do that again. We'll wait until the candle closes to look at that. So in late February 2007, again, we had a little bit of a drop, and then the market, more or less, actually more, rebounded out of that slight dip, and it would go on to put in its eventual double top, which brings me to my first point. If this indicator were to fire off, it is very likely, it starts a countdown. The question is, and the hashtag for this video, if I put one, will be, we're either starting the countdown to the recession or, and this is why we're not panicking, we're just watching, or it starts the countdown to the countdown. I know, that sounds really annoying, but I'll show you why in the grand scheme, it's really good to know this. It's not a huge deal today, tomorrow, but it could be in the months and possibly 12 months ahead. Once that indicator fired off, put in that little dip, and then the market went back up into its double top. And the market went up. I actually stopped this a bit short from that bottom, and we're not about timing the bottoms here. This is not what the video is about. This is about trends and protecting not your money, not your bets. It's about protecting your wealth. The market went up, let's say 15, 16%. So that was my first point. If this indicator fires off and this countdown or the countdown to the countdown begins, there is absolutely time and room for a final bull run. There is plenty of time. Crypto bull runs happen. A year is actually a long one. Usually they're over in like 9 or 10 months. So from this bottom, let's do from the indicator firing off to the end of the double top, which is the last time before the crisis, the recession plunge, the last time that you could have purchased and still made money, was 32 weeks. 32 weeks. What is that? My brain's on fire. That's what, 8 months? So you had 8 months of time you could either continue to bet on it, which, is certainly one move you could make. If you're a believer in the upcoming crypto bull run, 8 months is plenty of time. I've said many, many times in conversations, especially in Discord recently, that, I'm expecting a bull run, first of all, but it will be probably more rapid and probably lower than anybody else is expecting. I don't think Grandpa Bitcoin is going to be, if it gets to 100K, it'll probably stop right around there. Maybe sting upwards to like 110, maybe 125K. But honestly, I'd be more than happy to start DCAing my way out of crypto if Grandpa hits 100K. As in addition to Ethereum, my actual bet, in addition to Ethereum hitting the numbers I'm expecting, which is somewhere between 10K and 17K, probably an average of 14K. I'm expecting about a 10x, something like that. But this is just to show that even if this indicator fires off in a few minutes, there's plenty of time. And not only that, but there's plenty of time for crypto to have an entire bull run and for you to prepare your accounts, both crypto and standard or TradFi, and just, get your affairs in order and kind of prepare for what may be a slight downturn, which the kind of downturn we'll talk about in a second. But the point of this is to say that, from February 07, when the indicator fired off, to the eventual double top in October 2007, plenty of time. And in fact, in addition to this indicator firing off, which the indicator we're looking at, just to remind you, is the first weekly higher high on the yield curve, which suggests the start of yield curve inversion. We can even look more closely at when the actual inversion occurred. Now, this part is more art than science because, on the weekly, you can see, it goes up and down, never putting in another lower low. That is a key. We never set a new lower low. So it was in the process of inverting, but it goes up and down and up and down. Now, I've tried to figure out numerous times what constitutes a full inversion. What I'll show you across the other, there's two more time periods to look at. What I'll show you is I've generally come to believe that the inversion is sort of done. So I really should have prepared better. This orange moving average you see here, that's the 100 week. At first I thought that would do it. And so, you could say, oh, the inversion happens when the yield curve, rockets back above the 100 week MA. But that doesn't always hold true. In fact, I think we're already, the 100 MA is just so much lower right now that jumping above this would be a pretty dangerous bet for the inversion to occur there if you were betting on the uninversion. So what I've found across the other time periods, and that I'm probably going to lean toward myself personally, this is not financial advice, but personally, I'll count the yield curve as being inverted when it pretty much holds the 10-week as support or begins to really hold it as support. You could argue that's here in July 2007, or maybe you want to see a few more touches on it and just, wait for September. Obviously, you're past the peak at that point on, broad markets, but it's not the end of the world. In fact, let me show you why it's not the end of the world. If you wait if you were to do July 2007, when it breaks above, when it holds the 10-week MA, when the yield curve uninverts and holds the 10-week MA for the first time as support, you're right here. That's a pretty spectacular point. If you were to sell here, you miss out on a little dip and a little bounce. So, market makers are going to make money. There's still more opportunity to make money, even when everything is looking bad. But look, it's going to drop 11%. And then, from the bottom, forgetting about the dip, even if you just held, you're actually missing out on a whopping 2% rise. Wow. For me, and I'm all about managing risk, I'm more than happy to lose out on, let's say you time this perfectly, 14% from the bottom of this dip, if you're some kind of magician, 14%, or, even just as little as 2%. I'm more than happy to miss out on that, in order to escape, what was this, negative 55%? So from a risk management point of view, it's all about the individual, but let's just say if you were to get out when the yield curve first holds that support, which is, that is the wrong button. That just posted the YouTube stream. Let's make this a different color. So this is where the yield curve first holds support. I think you would be perfectly happy a few years to even probably a decade later, because it takes 13 years for the SPY to set a new high. Not 13 years, 6 years. Jesus, I'm getting my points mixed up. That's the NASDAQ. Anyway, if you were to, start preparing your portfolio here the first time it holds support, I think you'd be perfectly happy. Then again, if you wait until September, which is right around here, which is when it gets above, I'm getting my points mixed up. So going back to September, we had, this is where it held it for a second or third time. Yeah, we had 1 in July, 2 September, and then in October it dipped below for the first time, which is, I don't know, maybe that could be an indicator, but I'm not tracking it. Even if you wait for the second touch of September of 2007, why does this keep resetting? That is super duper annoying. If you were to wait for September, which is over here, so you would have been in the middle of this dip. Again, you miss out on those last few gains, and there's going to be some heavy gamblers saying like, oh, you're missing out on a 4% rise. Oh, I made all this money, and then they lose half of their net worth. I think even if you get out in September, that would still make most people pretty happy. So this all just plays into the idea that there is plenty of time. We're going to take in all the information. We're going to keep looking at indicators, and there's nothing to do today, tomorrow, this week, this quarter, this month, this quarter. It's just taking a look. So let's go back to the next time period, because I'm spending a lot of. I'll fast forward a bit now that we've talked about the two main sort of indicators for this great financial crisis time period. I'll be able to move faster through the other two. And as I'm scrolling over, let me just say I do not anticipate whatever this recession, correction ends up being. I do not expect it to be a negative 55% drop down. We are nowhere near that level of crisis. The money supply is too high. The economy is too strong, or was too strong. It's coming off of a too strong position, I should say. That there should be a blanket that stops us long before then, and I'll explain that when we get to the third time period. However, first, let's take a look at the dot-com bubble, which is a structure we do not resemble, in my opinion. So we're looking at this only for the purpose of the indicators. So let's go back to our yield curve chart, which with how much time do we have left? Did it close? Oh no, we've 20 minutes. 20 minutes, and it's above. Oh boy, very exciting doing this live. Okay. So let's go to the yield curve chart, and I've put in the higher high indicator. Sort of going quickly through this, after the low was put in on the yield curve weekly in the late August of the year 2000, Y2K. After that low was put in, we put in the very first higher high on the weekly, that is above whatever this high was. Again, numbers don't matter. You can see it on the chart very clearly. After this was the old high, and then we put in a new higher high and would never again set a lower low after September 18th, year 2000. Let's take a look at the SPY chart. I have looked at it before. I'm not sure. I don't remember the exact numbers, so hopefully I didn't leave too many surprises for myself. But generally it all fits the theory. So we're looking at, again, late September, year 2000. What happens? Let's look at the week of... Oh, this doesn't line up perfectly. Oh, wait, that's 99. Whoopsies. September 18th. So this is white because this was the higher high. Now, what are you noticing? You're probably saying, K-Brot, where's the timer? What's going on? Yeah, in the year 2000, with the dot-com bubble bursting, the weekly higher high firing off did not provide 8 months of runway. It did not provide time for a bull run. It did not provide, it did not give you, a full 9 months to a year to prepare your position. However, let's just take a look. First of all, as I said, I don't think our structure looks anything like the dot-com bubble. It simply doesn't. There's numerous other charts I've gone into and other videos and on Discord that show we don't look anything like the bear market of 2001. We're the traditional finance is in a bear market. I'm not, towards the end of a bull at least, but it doesn't look like this. So we're just looking at the indicators, and what the absolute worst case scenario was when the weekly higher high fired off. You stopped. SPY was at 95. Oh boy, remember when SPY was under 3 digits? God, what a time that was. So it was at 95 or just underneath. If you were to, obviously, shore up your positions here, you're a magician. You've done something amazing, and you've escaped a drop of what did it get down to? 62. So about 30%. Oh no, I'm sorry. I didn't scroll over enough. I thought it was worse than that. I think it was, so 45%. Pretty nasty in the dot-com bubble burst. So you've escaped a 45% drop. If, if you show up your positions right on the indicator and magically hold through the entire time, you're some kind of wizard, then yes, you have pulled off an economic miracle. Your family is probably set up for the rest of their lives, because you're not going to see that number again for, 7 years in the SPY. That's if you follow that indicator. But if I remember correctly, let's go back to the yield curve chart. Let's see the first time it's that the yield curve begins to hold support. Oh boy, the yield curve went up again. Oh, this is so nerve-wracking. It's going to be crazy. It's going to be crazy. I might just stay on this stream, I'll probably use up all the time anyway, because I usually run long. But man, to see that happen live would be very interesting. So here we have we're back on the yield curve, and we're looking at September. What are some other structural points at which you could shore up your position, prepare your portfolio for what you believe is coming? There's a couple of options. One is, again, the first time that the yield curve holds this 10-week support. Now, it's odd because compared to the last time we looked at it, before the financial crisis, it wasn't forced to hold support until it had already broken back above the 200-week. That is, it had completely uninverted. Here, you get some indicators a little bit early on where it is actually still inverted, the yield curve that is, but it has already started to test. So somewhere around like late October of 2000, or maybe once again let's take a look at, so we have one in late October, we have one in mid-November, so late October, mid-November, and then for sure mid-December. So let's remember those: late October, mid-November, mid-December. I have to write all these down because my goddamn trading view won't stay put. Okay. Nope, that's 2008. Keep going. Okay. So we have tests here. I'm just doing this blind, so I'm just going to do it, and we'll see, come what may. And we had one in, mid-December. So these are all potential times where the yield curve was actually still inverted, but was beginning to hold that 10-week support. And what does that mean for a portfolio? Let's zoom out. So yeah, let's zoom back in. If you were to, miss out on, this one in September, or this one in October, or this one in November, maybe like finally it takes until December until you're like, okay, I'm feeling good about this indicator, and it's time to start, preparing my portfolio for a different looking market for a few months to maybe a year. Oh man, like it's already dropped so much. It's dropped 13%. Oh, I feel terrible. And then, you're going to feel even worse in January when it gets that little bounce. It goes back up 4%. Oh, maybe you've done something with your assets. You've rolled some things over into, less risk. You probably feel terrible, right? And zoom out, and zoom out, and zoom out. I bet if you were to take that indicator, even the latest one, and drag it all the way down to the depths of that market at negative 39.5%, 40%, you're probably feeling still pretty good. And in fact, you'll have plenty of opportunity to DCA back in over the next 2 decades, because it'll go back and forth across that number for a long, long time. Again, SPY was 94. We don't leave 94 in the distance for good until, 2012. So again, you've got a couple different points at which you could decide this indicator is working for you. It's going to be on a personal basis, your amount of risk management, and how your portfolio looks. But once again, even though, as we said, the weekly higher high indicator didn't give us it, it wasn't the top of the market, and that might make you feel bad at first. But you're going to get some additional potential indicators when it starts to hold, when the yield curve begins to hold support, and we're going to have still 1, 2, 3 months worth of information and indicators telling us, hey, the market's still looking kind of unhealthy. It may be time to rethink our portfolios. Again, leads into the theory that there is plenty of time. Okay, so let's go to the last time period, for which I actually can no longer use SPY because the index did not exist. We're going to the old-fashioned SPX. And so Let's go way back over here where I have some things already marked off. Hopefully these correspond to the yield curve chart. So here we are. We've arrived at, wait, K-Brite, why is your line in 89? Don't you mean 87? With the stock market, the Black Tuesday or whatever it was? No, wait, Black Thursday. Black Monday? I forget which day of the week the 87 crash was. But anyway, no, we're not looking at that. We're looking at the 1991 recession. What? 91 recession? Has anybody ever heard of this? The 91? Yes. There was a recession in 1991. Roughly during 1990 into 1991. As you can see, the actual drop happened in 1990. But it's generally remembered as the 1991 recession. And even worse is that if you go back and read newspaper articles, newspaper articles, the government didn't call the recession until like 1992. So it was already, as we've discussed before, it takes a long time for them to actually acknowledge recessions. It's usually long over and has recovered by the time it gets declared a recession. So that's the 1991 recession in a textbook nutshell. Let's take a look at indicators. First up, let's see where the yield curve was back in 89. Let's take a trip through the time machine. Okay. Interesting. Okay, so I marked off May on that other chart. And I think that's because we had this massive surge suggesting an uninversion. So already you can see this is one hell of a messy chart. The chart, was just getting started in like early 1988. So the moving averages are more easily affected because any sort of funky movement, it hasn't had as much time to smooth out because it's only a 2-year-old chart. And so things such as this May 8th, 1989 candle can throws me off. That's probably why I marked it on the chart earlier. Let's take a look. So this is May 8th, 1989. And here is, this is late May 1989. I don't know why I have this like this. That's actually kind of random. That's not anywhere near. Anyway, if you were to go by that first indicator, I think it's over here, May 8th. And this, again, still feeds into the theory that it's certainly started some kind of countdown. It's given you a chance. But if you go by that indicator, you have tons and tons of time to get your affairs in order. You have until the actual double top, which you don't have to wait for. Until the actual double top in July 1990, you have well over a year, 61 weeks, to get things in order and sort of take a breath and see what you want your portfolio to look like. And that's how long it takes to get to the double top. And if you take a look, 20% in the SPY, just the S&P actually. So traditional markets, broad markets go up almost 20%, about 20% from that indicator firing off to the actual top. Plenty of time, again, for a crypto bull run. As we said, this is about a year for it to resolve. Actually, a little over a year and 2 months. And so there's plenty of time for not only a crypto bull run, but a traditional finance final bull run before a little reset. There is time. And you don't need to panic. We're going to have plenty of time for further indicators. I'm going to do even more indicators in a second. And, this kind of lines up with a lot of economists are saying, that the S&P is going to go up, 15, 20%. Still, I think they can be right in addition to the economists who are betting on a recession. I think the reason why there's so much turmoil and so much back and forth is because I think both things can still happen. I think this is probably our recession indicator, our big one. And yet, in the time it takes to get there, the market can go up that 20%. Everybody can be right. And so it's about being consistent and holding to your beliefs and your risk management that you can take advantage of both things. So if you were to go from that funky May indicator, yes, obviously you're pretty happy about that. You've got potentially, if you get spooked in October of 1989, you miss out on a whole 2% rise into the eventual double top almost a year later, but you're saving yourself 18.5%, on the eventual drop down. So you're probably still very, very happy. All of this is showing you no matter what your move, as long as you're consistent and you're managing your risk, almost whatever indicator you choose in the lead up, you'll be fine. You're going to be fine. Hell, even if you don't buy back into the market, let's just take a look at this. If you take that possible outlier of a first indicator and you, again, not financial advice, let's say you sell in May of 1989 and you don't touch a goddamn thing in your portfolio until, what you see as the bottom of the market, which could be this wave trend down here. You still get to DCA at a 5% discount on the S&P, which is huge. For crypto, who knows what that could be? That could be, that could be 45 to 50%. That's if you're a complete, I don't want to use the term scaredy cat. If you're a complete conservative about your portfolio, that's what you're looking at. Who wouldn't be happy with that? A 5% discount on the S&P, and hopefully you've managed your portfolio such that whatever you've done with your assets here in May of 1989, you've put them to work for you in some other way, either with, I don't know, property or loans or whatever you want to, bonds, whatever you want to do. So now let's take a look at some other indicators, because I may have plopped that line down before I'd done more thorough research. Oh boy, we are 7 minutes away from 7 minutes from heaven, and it is currently firing off. I gotta hurry this video up so we can watch. Okay, so back in 1989 and into 1990, the yield curve is uninverting, reinverting. It's going crazy. It's a very young chart. The moving averages are really tough to discern what matters. So I think what I put on this chart was, this is, again, more art than science. You'll have to look at this chart yourself and determine if you agree with me. But I think we can more or less agree that because, gosh, look here, it put in a lower low back in June of 1990. Good God, this is crazy. The last time it put in a weekly higher high and no longer put in a lower low on the yield curve weekly chart was July 1990. That's why I chose to put this line here. I'm not saying it's the end all be all, but it's what I decided, and I think it's a pretty agreeable point. So let's look at July 1990 on the SPX and see how much time we had to prepare from July 1990 on, what things were happening in the broad markets. Let's put this on. Look at that. I don't know if I lined this up perfectly. I'll be generous and put it on the red candle because I don't know. I'll be generous. Even so, if you wait for that, so this is the higher high. That lines up almost too perfectly. That was the double top. You got the double top in 1990, and then that's all she wrote. Now, it is my belief that structurally our market resembles 89 to 1991 more than any other market right now. I've waxed and waned about, over the past, however long I've talked, economics on Reddit and then Gaben and then Discord and YouTube. I've talked about what the market's most resembling. And as we get closer and closer, views change. That's the nature of life. I am now of the belief that whatever this recession or correction looks like that's upcoming, I think it's going to be closest to 1991, which is to say, not all that bad. The 1991 recession, where the economy contracted for sure, and it did drop. It dropped 20%, which is just classified as a correction. It was a recession, but it was honestly just as low as a standard correction. It found support at the 200-week. We're talking about the S&P. Found support at the 200-week, well above the line of doom, and that was kind of it. It was over. You had, about 2 months worth, really 3 months to DCA back into broad finance, broad markets, and it was over. So even if we were to just plunge right now and drop 20%, it's not all that bad. And you have, ample time to DCA back in. That's not to say this is going to happen, but this particular indicator, the weekly higher high, lined up perfectly with the double top. However, if you remember, I don't want to mess up the charts again, but if you remember back on the yield curve chart, it was also a very late indicator, and there was tons of turmoil leading up to it. So you had tons of time. We can dive more into those charts, to see, if this thing fires off, we can do a subsequent video looking at, what were these peaks, concurrent with. Maybe there were other indicators in, October 89 or, January 90 or, May 1990. we can certainly look at that. But for right now, even in the worst case scenario, you know, if you were to get out at the bottom of this candle, or not get out, but, you know, rearrange your portfolio, you know, sure, you could save yourself 20%, or it's a meager like 6 months until we're back. So in 6 months, there can absolutely be a crypto bull run. That's plenty of time for a crypto bull run. You know, if this were to be the scenario. And not only that, but the market will recover fairly quickly, and you haven't lost very much. So in terms of risk management, even this super late indicator seems to be a pretty good one. The one that doesn't work doesn't work as well is the 10-week support. Although, actually, we're kind of doing this live with 2.5 minutes left until the yield curve closes. Let's see. I'm doing this part entirely impromptu. Let's see if where it actually could have been said to hold support on the 10-week, which is the red line. A little bit in July 89. Not great. It was hovering, and then it formed an island, and then it plunged back through, and then it re-inverted. Oh, man, this is crazy. When's the last time it really held support? Gosh. It doesn't stay above the 10-week reliably. It's just bouncing and going crazy. You have a kind of... Here's that January 90. I know we had a peak in January 1990. This could have been... This was one. It you know, it more or less held the 10-week. It kind of closed below, but it kind of held it. Yeah, we're going to have to dive into these in another video. I think... I'm just trying to see if there's an earlier indicator, earlier than, you know, July 1990. You could say, it looks like this June drop was an outlier. We could be looking at something like April 1990, which is where it was all closes above the 10-week, with the exception of this outlier candle where, you know, you take a pie in the face for a week and then and it comes back. So let's take a look at, make this one blue so I know to look at it later. So April 9th, 1990, let's see if that corresponds to anything. And this will kind of be the last thing we look at today. I don't want to take up too much more time, especially as we're a minute away from close. Oh no, let me put this on there. April 1990. What did I say? April 20th? April 9th? Something like that? Somewhere around here. That's not bad. That's not bad. There's other opportunities though. I think I saw something in December 89. So we'll take a look at these peaks. For now, let's go have some fun. We're back on the yield curve chart. Let's go all the way down to the daily, where it's gonna close. And oh my goodness, we're doing this live, ladies and gentlemen. It is currently above and about to fire off. So regardless of how we approach this indicator, what we believe it means, what the countdown means, this is still a momentous occasion because this only fires off like once a decade, and the candle has closed, and it has closed above. Now, sometimes the market does, and you guys have seen this, I've seen it too. It's always frustrating. Sometimes like TradingView or the markets, something fucks up and it like changes the value. And so it's, you know, we just watched live as this indicator fired off for the first time in 16 years. More than that, actually. Sorry. 16 and a half years is the last time we saw this indicator. Jesus, I feel very, it feels very momentous. However, I also understand that like funky things happen at market close, especially on the weekends. This could be like reevaluated, and it would not shock me in the slightest if it gets like reevaluated and it ends right at 479 and just screws with all of us. I just want to put that out there. It is possible. I've seen it before. But for right now, as it stands, ladies and gentlemen, we have a weekly higher high. I'll leave this question mark in until like it closes, because like I said, the daily candle can sometimes get screwed up. Like what if I'm just going to reload the page. Hopefully this doesn't like reveal a whole bunch of personal information. Yeah, I mean, it's stuck so far. I don't know. Anything could happen. But I just want to reiterate how important this is, because no matter what this indicator leads to, whether it's, you know, an immediate sort of decline for the markets, which I don't think it is, but whether it's an immediate decline or if we've been given, you know, an 8-month to 1 year head start to start, you know, kind of looking at our portfolios in a different light. Either way, this is huge. This is the This is the fourth time it's happened. Gosh. Well, I'll just let you in on a secret. It's the fourth time it's happened since I was born, right? Yeah, I don't think there's anything. I mean, there could have been one for 1987, but I can't speak to that. The chart didn't exist. Wow. Like, this is huge. This is huge. Even taking into account the ups and downs of 1989, like, only one of these can really be counted as a higher high. At some point, in all this mess, at some point, on an infinite scale, it left behind, it set a higher high. We're sort of doing our best to guess when it was, but realistically, this whole mess is one indicator. So, wow. Whew. Big moment. Let's quickly go back to 89 and just finish up some quick sort of back of the napkin analysis here to see if we can find some peaks. Let's actually work backwards. So I'll do this fast because I don't want to take up too much more of your time. So back here, we picked out some peaks. Let's say August, late August, October. God, there's so many. Late August, October, and let's say late August, October, and late December. Late August, October, and late December. Late August, October, and late December. Okay, we're going to work backwards. We're going to see what was happening during those time periods. See if we can just find any trends, because if I'm good at anything, it's pattern recognition. Okay. Late August. Not great. It would be somewhere in here. I guess, like, there was a kind of a golden cross on the moving averages, but I can't, in all good conscience, put an indicator here. This doesn't mean anything. I guess this, like, thing back in, like, first week of September, the yield curve, like, re-uninverted really rapidly. Maybe. Actually, you know what it is? You know what we could say it is? Is a fresh lower low after the higher high outlier? I'm really stretching here. This is pure, like, you're seeing this live speculation. It looks like it was the first time, I don't know, the first time maybe a new higher low was put in after the outlier higher high. That's about all I can say. Because it didn't go back below here, or didn't close. No, it did. Shit, it closed back below here in October. Oh, which is, we said, one of the points. So, here. This was an exploratory one. I don't think that one counts. But this was actually the last time it closed that low, with the exception of the outlier in 1990. So, maybe the higher low is an indicator worth watching. And again, you're not really going to know until you know. Because how could you? You can get a week that starts down here, but then it closes way back up. So it's not science. It's going to be a whole lot of artwork, but that has potential. This was a higher low in that week of October that we picked out as one of the peaks, and then the last one was late December. I think it was Christmas, right? Which was a higher low, another form of a higher low. Now, granted, you don't know it's a higher low until confirmation the next week, so, debatably, you either look at the indicator here or in January. But either way, there was a fresh peak in the market that I recall when we just looked at it. Oh boy, I moved the line of doom. Let's not move the line of doom. That's very important. So back here we had, ignoring the August one, we had October. This was the higher low. That's a good one to watch. And here's December, January. Another nice peak. There's a lot of, so higher lows could be the thing from the 89 session time period that we can keep in mind. So I think this is pretty beneficial. We've got oh shit, the charts don't match up because I put the other indicators on the SPY. I'll move these over before I do like any more captures for Discord, or before I do a next video where we can dive in more. I'll move these over so that they also reflect the lines from the SPY that I put in. I'll make sure everything matches up before another one, but I don't want to take up too much more time. And then, nobody's in chat, which is totally fine. But I promised to do a quick little session on crypto and what the next couple weeks might look like. Again, I'm waiting for, I've discussed before, I think just in Discord, I'm waiting for bigger indicators, which is to say, 6 weeks from this line. I don't think I didn't make a video about this. I know because I haven't made a video. So I've been looking at the wave trend indicator, which is just a really, really rapid primer. Here's the wave trend, which is a combination of momentum oscillators and volume, and gives you a really good idea of direction for an asset. We're looking at Bitcoin because during a bear market, usually Bitcoin's indicators are more affecting. Not saying important because I don't care about Bitcoin, but in terms of following crypto as a whole, it's good to notice these. Bitcoin's wave trend crossed back into negative for the first time towards what I believe personally is the end of a bear market, first phase of a bull market. It crossed back into the negative here, back in the first week of September. And the reason why I'm watching for the middle of October, and I'm not really making any big statements or moves right now until the middle of October, is because the same thing has happened in each bear market where, actually, let me start with the first one because 2019 is a bit unusual due to COVID. When Bitcoin dropped negative on the wave trend, on the weekly wave trend, it dropped negative at the tail end of the 2012 bull market / the start of the 2013 bull market. When it went negative on the wave trend, that actually represented 6 weeks later, it went into what I call up only mode. It put in a higher low and Bitcoin never saw that number again. If you want to know, it was $4.50. Yes. Oh, I can't believe I owned Bitcoin back then. And spoiler alert, I did not keep it. So you don't have to be envious of me. But I had Bitcoin back in those days. And I'm an idiot. Anyway, the wave trend, 6 weeks later, it was confirmed to be up only mode. And Bitcoin never dropped below $5 again. That was at the tail end of the 2012 bear market or the start of the 2013 bull market, however you want to look at it. Fast forwarding, Grandpa Bitcoin did the same thing. It went negative on the wave trend at the tail end of the 2014-2015 bear market, aka the start of the 2016-2017 bull market. It went negative on the wave trend on the weekly in late August of 2015. And by 6 weeks later, it confirmed with a higher high candle that it was in up-only mode. Bitcoin closed the week prior. Bitcoin closed after a monster hammer candle at $228.50, and it would never see that price again. Again, it was confirmed 6 weeks after the wave trend. This next one, the 2018-2019 bear market / leading into the 2020-2021 bull market. There's a caveat here. Bitcoin did go negative on the weekly wave trend. Again, October of 2019, which most people can agree was more or less the end of the bear market / the start of the bull market. At least it was putting in the structure for the bull market. I know what you're about to say. It drops lower, but it still holds to the theory mostly. After the wave trend, 1, 2, 3, 4, 5, 6 weeks later, here in November, Bitcoin put in a reversal doji. And at that 6 weeks mark, it never touched that value again. Or so we were led to believe. Now, Bitcoin closed the week prior in November at $6,900. And it is my belief that with the wave trend indicator and the 6 week mark, that it never would have gone below 6,900 again. Except there was a black swan. And if you really dig into the charts actually predicted that there could be a downturn. I'm not going to say the charts predicted COVID. That's stupid. However, the wave trend was leveling out in February of 2020. And I'll talk about this in a later video because the wave trend is now my gold standard for investments and trading. That's another video. But the wave trend was leveling out in February. You could have protected your portfolio heading into the March drop and then gotten back in and had plenty of time. The chart to follow there would have been a combination of the weekly and the daily, which is a little tight, I know, for certain conservative traders. But the wave trend would have protected a lot of your wealth. Anyway, but we're not talking about that. So the weekly wave trend back in October of 2019, and November 2019, I believe would have held I think Bitcoin never would have seen $6,900 again had COVID not happened. And in fact, let's put a little line there. Like, you can even see, look at this stall week in early April 2020. Like, late March, early April 2020, and then even throughout April, like with these touches on 6,900, that was pretty clearly an important number to the market, probably because of the wave trend indicator back in November, that 6 weeks wave trend indicator. That number was clearly important. It was touched 1, 2, 3 in a stall candle, 4 in a stall candle, 5 in a retest confirmation candle, 6 times. Hey, there's number 6 again. Okay, that's just coincidence. I'm not putting on a tinfoil hat. 6 times $6,900 was touched. That's kind of insane. That just showed up live. So hopefully you're all enjoying that. It was touched 6 times. It was clearly an important number, and then Bitcoin never touched $6,900 again. And as much as I don't like Bitcoin, I don't think it's ever going to be $6,900 ever again. So wave trend plus 6 weeks, which brings us to why I'm not making a ton of big, bold statements right now, is that here we are at what I think is the tail end of the 2022-2023 bear market, start of the 2024-2025, somewhere in there, bull run, depending on the yield curve. I think we're there, and Grandpa Bitcoin has put in a negative drop below 0 on the wave trend on the weekly. And it did that the first week of September. So 1, 2, 3, 4, 5, 6 weeks. God damn it, I did it again. That's the YouTube link. We are waiting for, I believe, middle of October to know what direction we're going. I think as long as we see, some kind of either a confirmation doji, and look, it may not take 6 weeks. This could ratchet back up above the 10-week MA, maybe back above the 200-week, and maybe up only starts early. But I'm not making any declarative statements until we get to at least that 6 weeks, which has held true throughout Bitcoin's decently long history. And that's why I can't say for certain whether, it makes sense that Bitcoin should go back down to 24.5 or even 23.5. So everybody wins with a retest of 24.5 with Bitcoin. I've said in Bitcoin, I've said in Discord, with a retest of 24.5K, you've got bears winning because they're making money on their puts and their bets that they can rebuy below. Bulls win at 24.5 because that's where the 50-week is. A bounce off there is just more structure. You've got the 50-week has turned up. It turned up earlier in the summer. So a bounce off of 24.5 at the 50-week MA is also good for bulls. That's building support for the bull run. And then, hey, even if you're like an options trader, you're a volatility trader, like obviously you're going to win. To get down to 24.5 requires a leap off a cliff, at least a small one. It's $2,000 below for Bitcoin, which isn't, massive, but it's like 7-8% from here. Yeah, 8.5%, 8.5%. So volatility traders also make money. Everybody makes money from Bitcoin going back down to 24.5, which I think would correspond. Well, okay, prior to this week, it would have corresponded with Ethereum 1400. With ETH, I think some additional volatility came in because there's some ETFs opening or something. Again, I don't, markets find news, not the other way around. So I think that's just adding volatility to the mix. I don't think the ETF changes much, other than maybe establishing higher level of support for Ethereum. But I think it's pretty easy to see. There's no support below the lows of if you get back below, 1550 on Ethereum, at worst, 1530. Or sorry, I meant to say certainly 1530, which are the low lows. The low lows. If you get back below 1550, it should be a quick trip to 1450 for a retest, support, and bounce. That, it just seems to make sense. There's no other supports. There's no other major supports here. Even on the daily, there's nothing here. There's no moving averages. If this gets reversed, for example, Ethereum's maybe putting in a shooting star. It's a little toppy. The potential's there. Granted, it is a higher high on the daily, but it is just a lower high on the weekly. And actually, wait a second. What's the RSI today? 58.12. That's not a divergence, but this was 48. Oh, so you've got a hidden bear divergence here, actually. You've got a lower high price, higher high RSI. So a bit of a topping tail on the daily and hidden bear div on the RSI. I don't know. ETH can certainly turn back down. There's no support down here. If you get a nasty candle back down if it retests 1580, bears push it down. They don't have far to go. 1565 looks like on the daily would put it into a retest formation. You see why I'm saying, like, yeah, there's no reason to make huge statements. It makes sense to me on the charts that Bitcoin retests 24.5 and Ethereum retests 1450. But as we know, crypto doesn't have to make sense. So who knows? Maybe we get the up only indicator and it's all over. Hopefully you've been like dollar cost averaging into these, because beyond this point, bears are getting greedy. It's been a really good bear market for bears. Bitcoin has put in the necessary structure, as it always does. It is, of course, vulnerable to drops. It can go down, there's multiple lines that say, Bitcoin and Ethereum, but Bitcoin can, grind back down through the end of the year to like 20K, with some stings down to retest the bottom at like 18K or 16K. That's all possible. But looking at history and looking at the charts and the indicators that have de-stressed my life, I'm not worrying about it. I'll see what this indicator says. And, if it retests 24.5 and 1450, that's just kind of bog standard. If it doesn't, that's actually less standard. So yeah, that's kind of that. That's my crypto take. Yeah. Okay. That's all I got. We watched live as a once in a, is it considered a generation? It's been 16 and a half years. There are people born after the last indicator, who can drink. And in America, they can drive. So, wow. Like, thanks for joining me. No matter what happens, this is history. This is gonna be on the charts long after we're dead. Fourth time in 35 years. Whew. Let's see what it all means. Hey, does the yield just start an up only and we uninvert and bad things come? Maybe. Do we have a head start and we've got, 8 months to plan? We're going to follow all these other indicators. We're going to see what happens, with the 10 week as it crosses back above. Do we hold it as support? Are we holding it as support while it's still inverted? So many things to come. But I hope that you enjoyed this little walk back through history, why today was so important, no matter what happens over the next week to year. And I'll see you guys on the next 51% attack. Thanks for joining me. If you're in the Discord, leave any follow-up questions. I know I was kind of flying by the seat of my pants today, but I'm pretty happy with this video. And I'm glad we all got to watch this indicator live. Let's see what happens. Peace.